When you utilize other people's money to control assets that increase in value and provide cash flow that increases your net worth, debt can make you wealthy. Leverage is created by good debt. You can manage an asset with a much higher value for a small monthly cost. Your gain is based on the support you hold, not the amount you are paid. By taking out low-interest loans and gaining more control over assets, wealthy people use debt to increase investment returns. Their help and capital are only used to secure loans with a good credit line for use in business and investing. While their borrowed money is working to generate returns and increase their net worth, their assets may also be earning returns. In this video, we will discuss 10 ways rich people make money with debt. The video will be amazing, so stick to the end. Before starting the video, smash the like button and subscribe to never miss out on any of our videos. Number 10. Using debt for living expenses. Investors might finance living expenditures using loans to avoid paying income tax and other taxable events like selling assets for capital gains. For instance, they can take a margin loan from their broker to purchase stocks for their portfolio holdings without having to deal with any of them right now, and they pay it back later by selling equities that have fallen in value without incurring capital gains tax. High-worth people can also live off asset-backed credit lines and only repay loans from sources with favorable tax structures, like selling a personal dwelling, which is often tax-free, losing investments, dividends that are taxed at a lower rate than income, margin loans, or stock capital gains that are taxed at a lower rate than a high-income tax bracket. Number 9. Margin account. In a margin account, the stockbroker lends the investor money or shares while using the investor's account as security to buy securities. When you trade on margin, your broker adds purchasing power to your account, allowing you to sell more significantly and frequently. You can utilize margin to increase your trade's leverage or turn over your transactions more quickly without waiting for them to clear after entering and quitting. Your outcomes are enhanced if you employ margin to boost the size of your trades. Your winnings are twice as big when you trade double the size of the position you would have changed without margin. But your losses are also twice as significant when you deal with double the size of the work. If the stocks they purchase may be utilized for total leverage, margin accounts often allow investors and traders to double the size of their entire trade position sizing. The main benefit of margin is that it enables day traders to keep their purchasing power without waiting for all their trades to settle. Number 8. Making your savings work harder. Many prefer to retain money in cash savings accounts as emergency reserves or a buffer, making them feel safer. This money would be better suited to be held in an offset account connected to your mortgage. Without having to lock away any money, you will increase your after-tax return and shorten the length of your mortgage. Number 7. Better cash flow management. To reduce bad debt, cash flow management is crucial. The main goal is to reduce interest payments, which can be accomplished in various ways, including increasing the frequency of payments, raising the amount paid, depositing your entire salary into an offset account, or using a credit card's interest-free period to pay for daily expenses, thereby freeing up additional funds for paying off your mortgage without incurring interest. Number 6. Short selling. The typical sequence of first buying, then selling stocks is reversed when shorting stocks. Selling short is the act of selling something that is not yours. When selling a stock short, you obtain the shares on loan from your broker and then sell them to a buyer. The claims will then be paid for by your broker. Even though you make money off the sale, you must use it to buy shares later to pay back your broker for the share loan. You are long cash and short the shares when you engage in a short side trade. You have borrowed shares using the credit available to you in your margin account. Once you have made a purchase to cover the short position, your broker can return the shares to the account from which they were borrowed. This will be your debit purchase price for repurchasing the open market claims you are missing. These days, everything is mechanized and done electronically. A short seller reverses the trade flow by selling and then buying back. Using debt, you can make money if you sell something quick for more than you'll have to pay to repurchase it later. You will also need to pay margin interest on the position size if you're short a stock. Any dividends payable on the stock during your short term must also be paid. When the stock market moves up and down, here's how traders can profit from both ways. Number 5. Leveraged buyout. Leveraged buyouts occur when the buyer or buyers of a firm incur a sizable amount of debt as part of the purchasing process, or LBO. The buyer will use the assets from the company being bought as collateral to buy it to leverage the company's future cash flow to settle the debt following the buyout. After a leveraged buyout, the buyer acquires a majority stake in the target business. Number 4. Leverage in real estate. With 5% down payments or monthly payments, purchasing real estate enables you to leverage your capital by multiples of 20. A real estate investor can purchase a $200,000 home with a $10,000 down payment and $2,000 monthly payments. Investors in real estate receive returns on the entire loan amount, not just the amount initially invested. The $10,000 down payment generates a 300% return, with a $40,000 investment return if the real estate increases in value from $200,000 to $240,000. To produce cash-flowing assets for monthly revenue through leverage, debt can also be used to establish monthly rental properties or homes that can be used as Airbnbs. The cash flow returns are based not on the property's capital, but on the total amount of debt. Number 3. Using lump sums wisely. You can sometimes get a sizable lump sum of money through bonuses, inheritances, etc. Try to use this money for bad debt repayment, or think about increasing your superannuation contributions. Number 2. Use good debt to pay off bad debt. You need to find a more affordable approach to pay off your high-interest credit card debt if you currently have a sizable quantity of it. One way to achieve this is to use a suitable type of debt to pay off this bad debt. Because home equity loans frequently have better terms and lower interest rates than credit cards, you can use one to pay off the debt that is excessively costing you. Even though you now have a home equity loan to pay off, you'll be saving money, increasing your wealth personally. Number 1. Debt consolidation. You are spending far more than necessary on interest and fees by managing several debts. You may find it advantageous, for instance, to raise your mortgage payment and use the additional money to pay off other types of unproductive debt, such as credit card balances and personal loans. Even if your mortgage payments may not change, you will use the house loan's lower interest rate to pay off debt with a higher interest rate. This was all for today. I hope you liked the video. Let us know your thoughts in the comments section below. Stay safe, and we will be right back soon with another video. For more information, subscribe and watch other videos